Okay, so just gone through the European cash equity close, so 4:30 in London. Let's just take a bit of a recap of the day's session and really a wrap up of the week, because it's been a really interesting one. Certainly from a second half of the week perspective, it was extremely quiet Monday, Tuesday, just given the significance of the events. Midweek, Janet Yellen semi-annual testimony has really kind of shook things up a little bit in terms of market expectations are certainly not as conclusive as what we were this time last week, in that Janet Yellen struck a bit of a dovish note with her uncertainty around specifically the inflation issue. That obviously midweek prompted a pretty big repricing then of expectations about how confident can they remain with the inflation figures that were coming up. And yesterday's PPIs didn't offer us much in the way of further insight into that, but certainly today's data was pretty interesting. So a quick recap of that. Firstly, we had US inflation rate. It came in year on year at 1.6%. Market expectations were for 1.7, the lowest rate since October of 2016. So fifth consecutive month of declines from the peak of 2.7 that was seen in February all the way down to 1.6. The core reading, though, I must stress, was in line, and it has held steady at 1.7. So that downward trend has stopped, at least for the time being, but obviously this is still somewhat worrisome for the Fed if they do have uncertainty about the future path of inflation. The other thing that obviously came out today was US retail sales. That as well was disappointing. That missed expectations. The control group, which is often looked at as the component reading of that report, as it's the one that the Fed will use in their GDP calculations and the bank models, that was weaker than expected by a fairly considerable margin. So that's not particularly positive either on the US high street. And then finally you had Michigan come out, and Michigan also showed some deterioration. In fact, the lowest reading since October 2016, mainly due to a fall in future expectations. And so got to put it in a little bit of context, I guess. From a Michigan point of view, we're still relatively high post-financial crisis kind of recovery of that sentiment gauge. However, this is a bit of a slowdown from where we were in months gone by, when we were in the peak of the kind of positivity from the fiscal promise from Trump. But obviously we know that he's encountering more and more issues that are delaying those more kind of market sensitive issues. In terms of the market moves today then, equities have been a little bit unsure, I guess, of how to really take this data, but generally speaking, S&P is still sat up around highs. And if we bring the Dow into shot to have a look at the Dow, if you just bring it up on my chart here, if we put it on a daily continuation, it really, I guess, tells a bit of a better story for the week as a whole, because we managed to print obviously fresh record highs in the Dow future back in the middle of the week on the back of dovish Yellen. I'll just clean this chart up a little bit. So that was that high there, and we're sitting just off there at the moment. So certainly the weak data is being translated, and the dovish commentary, into the fact that possibility that the Fed might not be able to fit in their additional rate hike. And so what this has led to is this, which is a repricing of the market odds of a third and final rate rise for 2017, which has now fallen below the key threshold of 50% as measured by federal funds rate futures. So that means that in the short end then of the fixed income futures or STIRs, basically what we're seeing is that the market is now disbelieving that in these current economic conditions the Fed will be able to deliver that final rate hike. Now it's only just below there. It was tracking at, well, let's have a look here, 40 kind of 3%-ish. So it's still to be monitored going forward. We've also had a couple of the first big banks report, so we've kicked off earnings season. Let me just show you this graphic here to kind of talk you through what we've had from that. So bank shares slide after bond rally, first set of quarterly results. US bank shares have bucked the broader market by declining, with investors eyeing a rally in treasuries in the first set of quarterly results from the biggest lenders. The other thing here as well, I guess from an interest rate point of view, is the banks tend to be fairly sensitive to interest rate expectations, just given the fact that they've had their margins squeezed by a low interest rate environment. A higher interest rate path from the Fed should typically result in better margins for the banks and net their profitability, but obviously if that gets pared back like what we've seen from the second half of this week, it tends to be more detrimental then to the near-term outperformance that sectors such as financials have had year to date. Also as well, obviously the more Donald Trump or Donald Trump Jr. continue to bring about external kind of disruptions, i.e. involvements with the Russians, which we've seen occur midweek, that as well just acts as a more of effect to slow down this implementation of the fiscal policies, and as such then all the more reason for the Fed to be as slow and cautious or gradual as they could possibly be. A quick look in the fixed income markets then. I guess if we put this out on a daily continuation chart, we can kind of encapsulate some of the moves certainly that we've had. Well, this is looking back from April, May, June and July, and it's really the last part of the graph which is most interesting, and that's because we've obviously had in the last 2 weeks quite a what has been termed a coordinated move to being more hawkish, and now with what we've had with this more dovish turn from Yellen, and also with the weaker data specifically today, we've paired almost 50% of that initial decline that we've had since that centre meeting which took place in Portugal, where we had Draghi, Carney and all the others kind of all together. Now, looking elsewhere, the other interesting moves that we've had today, and also to put it in some context technically, is sterling. Now, cable's seen a really nice push on the upside. It was already the pound outperforming this morning, and there was a bit of light relief from those reports I covered in the briefing, talking about the fact that there seems to be a bit more of a conciliatory tone coming out of Britain in respect to settling the divorce bill with Europe to get these talks really underway, because so far these talks really haven't moved at all. Europe pretty much steadfast that you need to settle this amount of money that's owed to the EU as part of their the predefined agreements of the UK being within the EU budgets, and so therefore a bit of movement on that front has led to some positivity that these talks might be progressing. And then of course you've had the extension of the dollar weakness on the back of the data today, Yellen midweek, and so sterling has pushed up to levels where, if we put it on a daily continuation chart, let me just stretch this out a little bit so you can see here, if I just clean this up slightly so it's a bit more obvious what I'm looking at. So here you can see really the top of the range that we've had, this double top in mid-May and late June, which is defined, well, if I kind of make this the range here, this consolidation phase, that was what circled there, the snap election called the gap lower, then the pre-hung parliament low, 126.25 in sterling futures. Well, interestingly then we've broken the top end of that range, so that puts us back at, in cable, the highest level we've traded going all the way back to what would be September. And so longer term, interestingly then, you know, when we were trading down at 120, you could argue this is what's fueled this inflation now issue that we have in the UK, with inflation up at 2.9%. The thing is though, we've had a full 10-point bounce from that referendum low in cable, and is this going to be something which can help mitigate some of that rising inflation which had been emanating from this such large depreciation of the pound, which obviously occurred here on the far left since the initial vote to leave the EU. So Bank of England definitely interesting. Obviously this week's been interesting from a divergent views that seem to be materialising across some of the senior members of the MPC. Ian McCafferty most recently being hawkish. We need to start unwinding QE is kind of the way that he wants to go. In order to do that from a sequencing point of view, it means we need to start hiking rates first. This is an opposite to the Deputy Governor Broadbent, which we heard from on Wednesday, who said that now is not the time to raise rates. So a couple of things going on there for the pound that's been interesting. And talking of the currencies and central banks, here's another one that's been very instrumental for some of the more sizable moves in the market, and this is here the Canadian dollar. So I guess if I put the Canadian dollar on a 60-minute, we can capture the week's movement, and it's really defined by that really big move that we had on the back of the interest rate hike, the first in several years from Canada to the upside. So we've moved interest rates up now to 0.75 from 0.5%. They also sounded surprisingly hawkish with their statement. And if you start looking on here on a longer time frame, on a daily continuation chart, then you're looking in dollar CAD of key breaks of levels not really seen. You've got to go back to really summer of 2016, and we're just below there this morning. You can see that wick. We initially tested it on the day of the decision, and now we've managed to follow through. Hawkish and a hike from Canada, whereas a dovish in context, Janet Yellen, and weaker data from the Fed or for the US economy. So you're getting a bit of a policy divergence, that fueling CAD gains. And so dollar CAD now downside. I guess the bigger target in the near future is going to be the 125 handle, and then 124.57 should we continue this trend to come all the way back down to the low point of 2016. Any push beyond there in future puts us all the way back down to summer of 2015 type levels. So the CAD's definitely been an interesting one as well for this week. That's pretty much it. I'm going to leave it at that in terms of the wrap for today. As I said, earnings season has now commenced. It certainly does ramp up in terms of the number of companies reporting when we get into next week. Let me just quickly refer back to a tweet that a retweet that I did earlier this week, and here it is. This is next week's kind of headline earnings reports. There are others that will come, but next week you've got the likes from the banking sector, Bank of America, Goldman Sachs, Morgan Stanley. From a tech point of view, you've got Qualcomm, Microsoft, eBay. From a sentiment stock point of view, you've got Netflix, which is quite often watched quite closely in the marketplace. And then you've got other big market capped type names like IBM are reporting, Amex are reporting, General Electric, and so it starts to intensify on that front. The one thing I would say in terms of earnings season, the market really hasn't moved a great deal on the back of the bank earnings today, and I think that's quite understandable. I think at this particular juncture, what is important is monetary policy again, and monetary policy decisions. And the path of policy is derived now from the performance of economic data. And inflationary aspects that we've seen today in the US would point towards potentially the Fed coming under some pressure to follow through on their hawkish intentions of tightening the balance sheet or commencing of that process in September, and then the hike in December. And so data and economic conditions in the US are something to watch very closely next week. And then I believe we also have the UK inflationary readings, which obviously will be a real key point of interest for sterling traders. Okay guys, that's it. So have a great weekend. Enjoy the Wimbledon final. I believe Roger Federer is just kicking off against Burdick now. Can he secure his 8th Wimbledon title, which would be a record? We shall see. I'll see you on Monday morning.